If you feel like you were working more, earning more, yet life keeps getting more expensive, the problem is not you. The problem lies in how the system is operating. The United States stock market is sitting at all-time highs. Major indexes keep setting new records. The screens are green, portfolios are up, and the numbers look great. And almost by reflex, we are taught to believe that when stocks go up, the economy is strong. When the economy is strong, the United States dollar must be strong. And when the currency is strong, everyday life for people should get better. It sounds very logical. It sounds very familiar. And precisely because it feels so familiar, very few people stop to ask a simple question. If that were true, why does life feel more and more suffocating? 30 years ago, a middle-class family in the United States could buy a home priced at 3 to 4 times their annual income. Today, that number has doubled, and in many cases, it is even higher. 30 years ago, a full-time worker could save enough to pay for their children's college education without taking on debt that lasted a lifetime. Today, student loans follow people for decades. 30 years ago, wages rose almost in line with the cost of living. Today, housing costs, medical costs, and education costs rise faster than income, year after year. Stocks go up, but life does not get lighter. This is not a personal feeling. This is what the data shows. In 1971, the United States officially left the gold standard. At that time, 1 ounce of gold was priced at 35 United States dollars. From that point on, financial asset markets entered a period of growth unlike anything seen before. Stocks rose, real estate prices climbed, financial instruments increased sharply over time. But at the same time, the United States dollar gradually lost its ability to hold value. Not in a single year, not during one isolated crisis, but steadily across multiple decades. These two lines do not move together. One line goes up, clearly visible. The other goes down, quietly and rarely discussed. And this is where most people get it wrong. The stock market does not measure the health of the currency. The stock market measures how much money is being pumped into the system. When more money is created, it has to go somewhere, and it usually flows into the places that absorb it the fastest, which are asset markets. Prices do not always rise because real value rises at the same pace. Very often, prices rise simply because the unit used to measure value is being diluted. This is not new, and it is not mysterious. Throughout history, whenever money is created faster than the real value of the economy, the same chain of events appears. First, there is more money. Next, that money flows into assets. Asset prices surge. People look at price charts and believe they are getting richer, but at the same time, that same currency buys less of the basic things in everyday life. Housing becomes more expensive, education becomes more expensive, healthcare becomes more expensive, and wages fail to keep up. This pattern appeared in the late Roman Empire when the currency was diluted. It appeared in Germany during the Weimar Republic when asset prices rose in nominal terms before the German mark collapsed. And it appeared in the United States after 1971 when financial assets exploded upward while the purchasing power of the United States dollar steadily weakened over time. Every time, the story is the same. The crowd looks at asset prices and believes the system is working well, while the system is quietly extracting value from the currency they use every single day. This is not a glitch, it is not an accident, and it is not unexpected. It is a behavioral pattern that has repeated enough times in history that it no longer can be dismissed as coincidence. And if you still believe that rising stock prices are proof of a strong currency, then one truth needs to be stated clearly from the very beginning. There are periods in history when assets rise not because society is becoming richer, but because the unit used to measure wealth is losing value.
Introducing the pattern and the mechanism. If what you just heard feels familiar, it is not because you have heard it somewhere before. It is because this is a mechanism that has operated repeatedly throughout history. It does not need to be named in order to exist. It keeps running whether people recognize it or not. To understand why stocks can rise sharply while the currency loses value, you do not need complex economic models. You only need to look at a very simple sequence made up of a few connected steps. This sequence does not depend on any specific country, ideology, or historical era. When the conditions are the same, the outcome is always the same. The sequence always begins with the same common point. Money becomes easier to create. Central banks expand the money supply. Interest rates are kept low for long periods. Debt is no longer the exception, but becomes the foundation that allows the system to keep running. These decisions are usually explained with very reasonable goals: economic stability, stimulating growth, preventing recessions from spreading. But in a monetary system, intentions matter less than consequences, and the first consequence is always the same. When more money is created than real value, it has to go somewhere. New money does not spread evenly across society. It does not flow directly into wages or the daily lives of the majority. It flows first to the places closest to where money is created: banks, financial markets, large asset channels. This is where the second step of the mechanism appears. Money begins to concentrate in assets: stocks, real estate, bonds, other financial instruments. As more money pours into these markets, prices begin to rise. This does not require the real economy to improve at the same pace. It does not require productivity to surge. It only requires enough money to be injected into the system. This is why assets can rise for a long time and rise strongly even when the lives of most people do not change very much. Rising prices do not always reflect rising value. Very often, they simply reflect more money chasing the same amount of assets. The next step of the mechanism is not about money or assets, but about perception. When asset prices rise, the system appears healthy. Indexes move higher, portfolios gain value. The numbers on the screen create a sense of reassurance. From that, a very common conclusion forms: if markets are rising, everything must be fine. But markets do not measure the health of the currency. They only measure how much money is being pumped into the financial system. While attention is focused on the markets, another process is taking place more slowly, but more deeply. The purchasing power of the currency is changing. The currency begins to buy less of the essentials of everyday life: housing, education, healthcare, daily living costs. This process does not happen suddenly. It does not create an immediate sense of crisis. It unfolds year by year, cycle by cycle, through small adjustments. And because it moves slowly, it's easy to overlook, especially when asset prices continue to rise. When you put the entire sequence together, the picture becomes clear. More money is created, that money flows into assets. Rising asset prices mask the problem, while the currency gradually loses purchasing power. This is why there are periods when, on the surface, society appears to be getting richer, but at a deeper level, value is being transferred, not from thin air, but from those who hold money to those who hold assets. This mechanism does not require broad agreement to function. It only requires the right conditions, and when those conditions appear, the outcome rarely changes. That is why understanding the mechanism matters more than following the news. The news tells you what is happening. The mechanism tells you why it keeps happening in the same way. And once you see this sequence, you will no longer be surprised when stocks rise while the currency weakens, because at that point, you are no longer looking at individual numbers. You are looking at how the entire system operates. In the next part, we will return to history, not to tell old stories, but to test how this mechanism is operated when similar conditions appeared in the past.
This example is not distant history. It is the United States of America, and it began on a Sunday evening, August 15, 1971. 8 p.m. Eastern Time in the United States, President Richard Nixon appeared on national television. There was no chaos, no obvious crisis, no immediate market collapse. There was only a short announcement described as temporary. The United States would suspend the convertibility of the dollar into gold. That word, temporary, is still in effect today. To understand why this moment mattered, we need to go back a little further. After World War II, the United States emerged as the only major economic power left fully intact. The Bretton Woods system was established in 1944.
The US dollar was pegged to gold at $35 per ounce. Other currencies were pegged to the US dollar. For nearly 3 decades, this system functioned with relative stability. Trust in the dollar was extremely high. Countries held US dollars because they believed they could exchange them for gold at any time. But then things began to drift. During the 1960s, the United States spent more and more. The Vietnam War, large-scale social programs, persistent budget deficits. Dollars were being created faster than the amount of gold the United States held. Countries began to notice this imbalance. France, in particular. Under President Charles de Gaulle, France openly questioned the system. They began converting US dollars into gold. Ships carrying gold started leaving the United States. By 1971, the amount of US dollars circulating around the world far exceeded America's ability to back them with gold. The system could not continue, and Nixon chose the only option left, cutting the link between the US dollar and gold. At the time, many believed this was merely a technical adjustment. There were no major warnings, no immediate sense of crisis. But mechanically, something extremely important had happened. The US dollar became a pure fiat currency. It was no longer tied to any finite asset, and from that point on, the pattern began to operate in full. In the years that followed, the United States experienced high inflation. The 1970s are remembered for stagflation. Prices rose rapidly, the purchasing power of the currency declined noticeably. But that was not the whole story. What is more interesting is what happened after the United States brought inflation under control through high interest rates in the early 1980s. From that point forward, asset markets entered an unprecedented long-term growth phase. U.S. stocks rose sharply decade after decade. Real estate became the primary wealth-building channel for the middle class. Financial asset prices grew faster than incomes. On the surface, America appeared to become wealthier. The Dow Jones Industrial Average increased by many multiples compared to the 1970s. The S&P 500 repeatedly reached new highs across market cycles. But beneath the surface, something else was happening. The purchasing power of the US dollar did not rise at the same pace. Essential living costs became increasingly expensive relative to income. A home that once cost 3 times annual income gradually became 6 or 7 times annual income. Healthcare costs rose faster than official inflation. College education turned into a long-term debt burden. Assets went up, but the lives of the majority did not improve proportionally. And this is the core of the pattern. After 1971, the United States did not become richer in the sense that had a stronger currency. America became richer in the sense that assets were priced in a currency that was steadily weakening. Stocks did not rise because the US dollar held its value well. They rose because the US dollar could be created more easily than before. Every crisis that followed reinforced this mechanism. In 2001, the dot-com bubble burst. The Federal Reserve sharply lowered interest rates. In 2008, the global financial crisis. Money was injected into the system on an unprecedented scale. In 2020, the COVID pandemic. The Federal Reserve's balance sheet expanded dramatically in a very short period. After each episode, what happened? Asset markets recovered faster than the real economy. Stock prices rose first. Home prices surged, while wages and purchasing power recovered much more slowly. No prediction is needed. No speculation is required. Just look at the repeated pattern of behavior. Since 1971, whenever the system runs into trouble, the solution has always been the same: create more money to stabilize the system. And each time, assets rise first, while the currency weakens another step. This is not a judgment. It is not a moral conclusion. It is simply a description of how the system has operated for more than half a century. For Americans, this example is not found in distant history books. It exists in everyday life, in housing prices, in the cost of living, in the feeling that you have to work harder just to stay in the same place. And when this example is placed into the sequence of mechanisms discussed in the previous section, everything aligns in an unsettling way. More money has been created since 1971. That money flows into assets. Asset prices rise sharply across decades. while the purchasing power of the US dollar gradually weakens. This pattern has been operating long enough that it is no longer a matter of debate. And what is notable is that this is only the first example.
The second example did not unfold slowly like it did in the United States. It happened faster, more violently. And because of that, it exposed a mechanism that in other places took decades to become visible. This was Germany after World War I. In 1918, the war ended, Germany lost, and the cost was not just territory or prestige, but finances. Under the Treaty of Versailles, Germany was forced to bear massive war reparations, denominated in gold, an obligation that the German economy at the time simply could not meet. Before the war, Germany operated under a relatively stable monetary system. The mark was tied to gold. Trust in money still existed. But the war changed everything. To finance the war, Germany temporarily abandoned the gold standard. Money was printed to pay for military expenses. After the war, the amount of money in the system expanded sharply, while the economy itself was exhausted. When the reparation payments came due, the German government faced two choices: raise taxes and cut spending in an already devastated society, or create more money. They chose the second path. At first, everything looked fairly normal. Money was printed to meet obligations. Prices began to rise, but no one panicked yet. In fact, in the early stage, asset markets even appeared positive. German stock indexes rose in nominal terms. Stock prices increased much faster than wages. Those who held assets felt like they were rising along with the system. But that was only true if you looked at the numbers, not at real value. As more money continued to be created, the pace of change accelerated. Inflation was no longer an annual figure. It became monthly, then weekly, then daily. By 1923, the mechanism was fully exposed. A loaf of bread that once cost a few hundred marks rose to billions of marks in a short period. Workers were paid twice a day because if they waited until the end of the day, their money had already lost value. Wages rose rapidly on paper, but purchasing power collapsed. And the most important thing here is not the images of wheelbarrows full of cash or the extreme anecdotes. What matters is the structure. Those who held cash were wiped out. Those who held tangible assets, land, goods, or foreign currency, survived. Value did not disappear, it simply moved. The moment the old monetary system collapsed, a new currency was introduced, the Rentenmark, and in that instant, a new order was established. The middle class, those who had accumulated wealth through money, was almost erased from the economic map. Meanwhile, asset holders entered the restructuring phase with overwhelming advantage. This was not an accident, and it was not a historical coincidence. Many later records show that allowing the mark to collapse helped the German government erase its domestic debt burden. Debts were repaid with money that had lost its value. Once again, the pattern appeared in full. Money was created to solve a short-term problem. That money flowed into assets first. Asset prices rose and masked the problem in the early stage. Eventually, the currency lost its ability to represent value. The only difference between Germany and the United States was not the mechanism, it was the speed. In Germany, everything happened so fast that it could not be hidden. In the United States, everything happened more slowly, was smoothed out, and stretched over many decades. But the sequence of behavior was the same. When people look back at Weimar Germany, it's easy to think of it as an extreme case that could never happen again. But if you remove the scale and focus only on the structure, the similarities become very clear. Money is created to cover obligations the economy cannot meet. Assets react first, the currency weakens afterward. That is what history has shown, more than once. After looking back at history, the natural question is this: what about the present? Are the things that happened in the United States after 1971 or in Germany during the Weimar era simply stories of the past, or are we witnessing the same mechanism playing out in a more modern context? If we set emotions aside and look only at the data,
The answer becomes very clear. In less than 2 decades, the global monetary system has gone through an expansion unlike anything seen before. In 2008, after the global financial crisis, central banks for the first time rolled out large-scale monetary easing policies. Interest rates were pushed down to nearly zero. Money was created to stabilize the system. At the time, many people believed this was only a temporary measure. Then came 2020, a global pandemic, economic lockdowns, broken supply chains. The system's response was almost immediate: create more money faster and on a scale than at any previous point in history. In just a few years, the balance sheet of the United States Federal Reserve expanded to a level that had previously taken decades to reach. The key issue is not the absolute number, it is the speed. Money was injected into the system far faster than the real economy could expand. Productivity did not rise at the same pace. Infrastructure did not grow in step. Production could not keep up with the speed of money creation. And just as this mechanism has repeated throughout history, that money was not distributed evenly. It did not flow directly into wages of the majority. It did not immediately make everyday life more affordable. Instead, it flowed first into asset markets. Stock markets rebounded quickly after 2020. Real estate surged in many regions. Financial asset prices reached new highs in a very short period of time. If you look only at the indexes, the system appears healthy, even prosperous. But at the same time, another indicator began moving in the opposite direction: the purchasing power of money. House prices rose faster than incomes. Food, energy, and healthcare costs climbed. The cost of living became a constant pressure for most households. What is striking is that these developments did not appear randomly. They emerged in exactly the sequence that history has shown before. Money is created to solve short-term problems. That money flows into assets first. Rising asset prices create a sense of stability, while pressure for everyday life quietly builds underneath. At this stage, the system is usually described using reassuring language. Inflation is labeled as temporary. Imbalances are explained away as supply chain issues. Hardships are framed as the result of external shocks. But when those explanations are placed alongside long-term data, they become far less convincing. Because the problem is not a single shock, the problem is structural. The amount of money in the system has grown faster than the ability to produce real value over an extended period of time. And when that happens, the outcome is always the same. Asset prices react first, the currency reacts later. This is the stage where many people begin to feel a contradiction. Their investment portfolios may be rising, but their sense of financial security is declining. Not because they did anything wrong, but because they are living in a system where value is being measured in a unit that itself is changing. In the second half of this section, we'll take a deeper look at one crucial question. If this is the same mechanism that has appeared throughout history, then where exactly are we right now in that sequence, and why is the feeling of unease spreading even as markets continue to rise?
On where listeners stand in this sequence and why this is the most confusing phase of the entire pattern. To understand where we are in this sequence, we need to look at indicators the system usually does not emphasize, not stock market indexes, but the relationship between money, debt, and the ability to generate real value. In recent years, United States government debt has continued to rise rapidly, surpassing levels that were once considered unthinkable. Budget deficits are no longer an exception during crises, they have become the normal state. Spending is sustained through the issuance of more debt, and that debt is absorbed by an expanding monetary system. At the same time, the role of central banks has grown larger and larger. They're no longer just interest rate managers. They have become the ultimate backstop for financial markets. Whenever markets experience major stress, the familiar reflex appears again: easing, support, liquidity injections. This creates a very unusual effect. Asset markets increasingly reflect less of the real economy. Instead, they reflect expectations about how much support the monetary system will provide. Prices are no longer shaped only by the supply and demand of goods, but by the supply and demand of money itself. Meanwhile, the currency comes under pressure from the very measures used to stabilize the system.
When money is created to fund deficits and calm markets, the quantity of money rises faster than the amount of new value being produced. So what is the result? Asset prices keep rising because money has fewer places to go, but the currency buys less of what people actually need. Not through one dramatic shock, but through a series of small, continuous adjustments. This is why so many people feel that the system looks fine when they look at the markets, yet feels like something is wrong in everyday life. These two experiences do not contradict each other. They are two sides of the same mechanism. When we zoom out and look globally, the picture becomes even clearer. Countries are beginning to diversify their reserves. The dominant role of the United States dollar in global trade and finance is coming under pressure, not because of a single political decision, but because the structure of debt and money makes holding dollars less attractive over the long term. These changes do not happen loudly. They do not appear on the front page every day, but they accumulate, and when we place them into the sequence described from the beginning, the system's current position starts to look very familiar. Money has been created on a massive scale for a long time. Assets have reacted strongly and moved ahead. The purchasing power of the currency has already come under pressure and continues to do so. This is the phase where history shows confusion reaching its peak. When most people look at asset prices and believe everything is under control, while the monetary foundation has shifted deeply from what they were once used to. There's no need to predict what comes next to recognize this. It is enough to compare today's structure with those that existed before. When the conditions are the same, the outcome does not need to be guessed. It has already appeared. And it is precisely at this stage that a sense of unease begins to spread. Not because markets have collapsed, but because more and more people realize that even as the numbers on the screen go up, the unit used to measure their lives is changing in a way that works against them. In the next section, we will speak plainly about that. Not about the future, but about the present.
If you feel uncomfortable hearing this, that is a completely normal reaction, because the most dangerous part of this mechanism is not that it is shocking, it is that it operates very quietly. There is no explosion, no clear day of collapse, no single moment when everyone suddenly realizes that everything has changed. What changes first is the feeling. The feeling that even though you work harder, save more, and try to do everything right, your financial position is not improving in a proportional way. The feeling that what once seemed stable now feels fragile. The feeling that the numbers are going up, but the pressure is rising with them. In the sequence we have just walked through, this stage is very familiar, and it is also the most confusing stage of all. This is when assets are still rising, but trust begins to crack. People see markets moving higher, but they no longer feel the same sense of security. They hear reassuring messages, but they no longer fully believe them. A gap begins to appear between what is being said and what is actually being experienced. That gap is not accidental. It appears when the system is moved far enough along in its own process. Historically, this is always the phase where the majority gets stuck between two realities. One reality reflected on screens, rising asset prices, high indexes, green portfolios, and another reality in everyday life, rising living costs, constant financial pressure, shrinking ability to build savings. When these two realities exist side by side, the danger is not collapse. The danger is confusion. Confusion about the cause, confusion about one's position within the system, confusion between feeling richer and actually being quietly eroded. At this stage, many people begin to blame themselves. They believe the problem lies in personal choices, in not working hard enough, not being disciplined enough, not being smart enough. But history shows that this is not a personal failure. It is the result of a structure. When money is created faster than real value, those who hold money feel the pressure first, not because they are wrong, but because the unit they use to measure and store value is changing. This is especially dangerous for the middle class, people who are not wealthy enough to stand outside the system, but also not poor enough to be protected by support mechanisms. Historically, this group has always absorbed the strongest impact at this stage, not because they are weak, but because they believe in stability.
They believe that working hard, saving diligently, and following the rules should be enough. And in a stable monetary system, that belief makes sense. But when the monetary foundation changes, the rules change with it, even if no one makes an official announcement. At this stage, the system is still operating. Markets are still open, transactions are still taking place, but the foundation is no longer the same. And this is the point where many people remain stuck the longest. They are not pessimistic enough to fully step away, but they are no longer confident enough to continue as before. They sense that something no longer fits, but they cannot yet put a name on it. They see historical examples, but believe that the present is more complex, more modern, and therefore different. That too is a familiar reaction. In every historical case, this stage comes with the belief that this time is different, not because people are naive, but because the system always tries to preserve a sense of normalcy as long as possible. That sense of normalcy is exactly what allows the mechanism to keep running. There is no need for panic, no need for force, only the need for enough people to believe that everything is still under control. But history shows that this is precisely the phase when the transfer of value is strongest, not loudly, not dramatically, but steadily, from money to assets, from those who store value in the old unit to those who have adapted to the new one. Recognizing this does not make you panic, it simply makes you more aware. Because the biggest risk is not that the system is changing, it is not knowing where you stand within that process. And if you were listening this far, you may have already realized something important. What makes this stage dangerous is not that the market is about to collapse, it is that many people are still measuring their lives using a unit that is no longer the same as it used to be.
At this point, there is one thing that needs to be said very clearly. What we have just walked through is not a prediction about the future. It is not a scenario that is about to happen. And it is not a call to action. It is simply how the system has operated and continues to operate whenever similar conditions appear. History does not repeat because people fail to learn lessons. History repeats because the structure of the system produces the same outcomes regardless of the original intentions. When money is created faster than the real value of the economy, assets always react first. Asset prices rise. A sense of getting richer appears. But at the same time, money slowly loses its ability to represent value. Not through a sudden shock, but through a long, quiet process. This is not a moral issue. It is not the fault of any individual, and it is not a conspiracy. It is the mathematics of the monetary system. Once you understand that, many questions that once felt confusing begin to make sense. Why working harder can still come with a declining sense of financial security. Why asset values rise while daily life does not feel easier. Why markets can move higher while confidence weakens. Not because you were seeing things wrong, but because you are measuring them with a unit that has changed. Most people do not notice this not because they lack intelligence, but because the system does not encourage questioning the foundation. It encourages focus on the surface, on numbers, on indexes. But understanding the system does not mean fighting it. It simply means no longer being confused. When you stop expecting rising markets to automatically deliver long-term stability, when you stop believing that everything will work itself out just because prices are still green, you begin to see more clearly, not to panic, but to avoid being lulled to sleep. If there is one most important thing to take away from this conversation, it is this. Rising stock markets are not always a sign of strength. Sometimes they are simply a sign that money is being asked to carry too much weight. Most major shifts in history do not happen in noise. They happen quietly, during periods when everything still looks normal. And the difference between those who get swept along and those who hold their ground is not luck. It is whether they are able to see the bigger picture. If you want to continue understanding how this system was built from the beginning, why it operates the way it does, and why these patterns are not exceptions but rules, then continue following this channel. Not to find promises, not to find predictions, but to see more clearly what is actually happening, while most people are still focused on the surface. Because in periods like this, understanding does not bring certainty,
but it helps you avoid being caught off guard. And sometimes, that alone is already a very powerful advantage.